perhaps a hurricane is coming, but that's not the case. His actions are confirming that they are preparing for something that is more deleterious in the economy. How much does he actually see that in the underlying data versus just act in a precautionary manner?
So some of this can become self-fulfilling. And Shonali, if I can bring you back in, and thanks for sticking with us. Are you going to start to see banks tighten up credit standards, underwriting standards, that ultimately you end up with a self-fulfilling scenario where the banks pull back and because of that the economy pulls lower too?
Yeah, I would want to point out what Jamie Dimon said even just a couple of weeks ago, that charge-offs could start to rise. I also want to point to the numbers here because the net interest income is lighter than what Wall Street was expecting. Remember, JP Morgan was saying that they would get a lot more with that rise in net interest income because of higher interest rates. Today is going to be a huge day where Jamie Dimon is going to be asked a lot about that conflicting force between a potential 1% interest rate hike and an inverted yield curve. If Jamie Dimon tightens lending standards, how does that pair with potentially consumers borrowing less? That home lending revenue plummeted, really, more than 20%. And card and auto was also weaker. So where is the money going to come from?
Let's talk about wealth management. You mentioned Archegos and Credit Suisse, like everybody else, is going to solve all their inward problems by wealth management, asset management. Let's all go to Asia and talk to rich people. JP Morgan, assets under management were 2.7 trillion, down 8%, driven by lower market levels. Okay, negative 8%, I guess, is pretty good. How does wealth management fit in for a ginormous bank like JP Morgan or a more focused effort like Fortress Gorman?
Yeah, and you know, we were talking about price to book. Morgan Stanley is more expensive on that measure than JP Morgan because there's an expectation that wealthier customers are going to fare this inflationary environment better.
But everybody's going for that market, right?
Everybody
wants to be a wealth manager.
And you saw those changes over at UBS to capture even more of the U.S. market. You're seeing also JP Morgan, Goldman Sachs, Morgan Stanley hire abroad as well because they're betting on some weakness on the European banks, hoping that they can take more clients both abroad and in the United States. However, to your point, that's not going to be a necessarily cheap endeavor to do. But I will also cite Mr. Dimon once more and say, citing Mr. Dimon, citing Mr. Bezos, saying your margins are my opportunity here. He has guided that he's been willing to spend to outperform in businesses like that because, to your point, Tom, wealth management tends to do better in this kind of environment because those customers hold up better.
Shonali, just quickly in 20 seconds, is there a bank out there with a big capital return program with a target on its back right now?
No, there are capital return plans, and we've been guiding it for weeks here, John. People have to mute their expectations. If you're going into an economic hurricane, you need to keep money on your balance sheet.
Shonali, awesome to catch up. More coverage from our Wall Street correspondent, our chief Wall Street correspondent through the morning as we get more details on these earnings reports. Lisa, that's JP Morgan. Up next is Morgan Stanley, but wow, does this one set the tone early on?
Absolutely, for the entire market. Interesting detail around suspension of the share buyback plan. They talk about the stress tests and how they want to get to a certain goal that were set out for them, goals that were set out for them in those stress tests, and that temporarily suspending share buybacks will allow us maximum flexibility to best serve our customers, blah, 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 blah. Yep. But it's because they want to get to those targets quicker. I mean, how much is this basically being forced on them?
Here's
also,
the top line from Jamie Dimon: we're prepared for whatever happens in the economy. We're taking another leg lower in this market off the back of this. We're down 1.4% on the S&P 500. More still to come from New York City. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Every developed market is facing the same problems in terms of high inflation, slowing growth, declining real wages.
This is going to amp up pressure on policymakers.
It's going to be a tough call for the Fed, to be honest.
They let the inflation genie surge out of the bottle much too rapidly with their shift to a backward-looking paradigm.
It's going to be a rough road the second half of 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here comes the hurricane from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio for our audience worldwide, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. We're down 1.3% on the S&P. JP Morgan lower, TK, the earnings out 10 minutes ago.
Yeah, it's important. I mean, they got some happy talk there about mobile customers up 11%, and I'll go with that. But, John, the financials here buried in the supplemental report begin to get the attention that you're going to hear at the press conference, earnings calls, or whatever you want to call them. Return on assets over year from a 1.29% down to 0.89%, and tangible book value. And John, I think this really says it all about Fortress JP Morgan. Tangible book value is up 1%. I mean, this is basically a big bank flatlining. You know, that's a little harsh, but flatlining given the tumultuous times.
The big headline of the last 10 minutes, Tom, suspended the share buybacks.
Yes,
JP
absolutely.
Morgan.
Yeah.
The stress test clearly kicking in perhaps in a bigger way over the next 12 months, given the volatility we've seen in this market. We've seen some massive corrections, TK.
I'm going to let Allison Williams tell me the stress tests matter here. I just think it's a very cautious, responsible, ginormous entity. And frankly, John, it heats up over what we're going to see from the other banks.
Lisa, the other disappointing factor in this earnings report is where you expected the strength to be, trading. It didn't show up.
That was where people were expecting some sort of offset to the investment banking side. On a bigger level, though, This is a really negative bellwether. This is the behemoth bank coming out, girding itself for that hurricane, again, putting their money where their mouth is in terms of what Jamie Dimon said just a few months ago. And how much do we see this reflected in the rest of earnings at a time when there is so much uncertainty and people are still building leverage? I can't get over this. The debit and credit card spending still expanding rapidly as people dive further into their savings and try to basically cap the difference and keep traveling and keep spending.
Are you saying you don't buy that consumer strong story we've been fed over the last few months?
There are signs of weakness, number one. And number two, again, what is the potential consequence of building leverage into a downturn, especially given that that was one of the main nodes of strength, was that the consumer balance sheet was healthy and strong. This, to me, just kind of defies logic.
Stock is off the lows. We're down 2.7% on JP Morgan. We were down 5%. Tom, this is one piece of a much broader puzzle this morning. Cross-asset yields over the last 24 hours, a yield curve that's deeply inverted in FX, the dollar a whole lot stronger, dollar yen. At one point, I thought dollar yen waking up this morning, Tom, might strike 140. Had a little look at 139, took a visit, came back down, but we're seeing some big moves.
Right now, 139.10. I mean, John, we're looking at JP Morgan, and I agree we need to have further scrutiny here on this major bank. And again, it sets up the other banks. Just again, the positive, the head count, 260,000 out to 278,000. But I'm going to guess Mr. Diamond, Mr. Pinto, and the rest of them, they want to know globally what's happening in the markets. And there's a new fragility this morning, John, as you see it with yen now back over 139 again. Weaker yen. And John, it's the way the yen is weak that is important.
Let's get you a picture of global markets right now. Futures are negative 44. Let's call it 45 and round down. We're negative 1.2% on the S&P. We are negative 93 on the Nasdaq 100, down 0.8%. Yields a bit higher again by 3 basis points on a 10-year, 296.50. In foreign exchange, euro dollar basically where it was. Euro dollar 100.13, negative 0.5%. And we keep going back to it, don't we? Get used to 93 on WTI. What happened to 150? Yeah. Lisa, 93.80 on WTI. We're down another 2.6%.
In another time, this would be a positive story because it would indicate that perhaps some inflationary pressure was coming off. But right now, this is demand destruction, the expectation that people will not be able to spend to the same degree that they have been doing over the past few years. That has just been basically confirmed, that negative view by JP Morgan's earnings coming out. Yes, their earnings were disappointing on an earnings per share level, but that was probably the less concerning aspect. The share buyback suspension highlights a lot of concerns, alarm bells, not only about the stress tests, but also about the condition of the economic outlook and what banks are doing, and frankly other companies, to gird against that. You saw a knee-jerk reaction to other banks. Morgan Stanley is set to report any minute. Those shares down by 1%, but in the Citigroup and the Bank of America, the other behemoths, you are seeing an even bigger drop. At 8:30 a.m., we get the latest read on U.S. data, initial jobless claims, and U.S. June PPI. I am looking at the PPI because what we're looking at is inflation data that is only causing the Fed to double down, at least in their rhetoric, in terms of aggressive rate hikes. How much are we reaching a pivot point where people are saying the negative outcomes are looking that much more likely because the Fed is going to be aggressive and they will keep going despite the potential recession risk and the increasing likelihood? And at 11:30 a.m., following on to that, Fed Governor Chris Waller appearing with our own Michael McKee at a forum at the Rocky Mountain Economic Summit in Idaho, talking about perhaps what the pivot point will be for him in terms of how fast he'll go, not just this month, not just in September, but through the rest of the year as the market prices in a 3.7% Fed funds rate. By the end of this year, John, we are bringing forward these rate hikes. They're getting more aggressive in terms of the market expectations, and that is changing some of the estimates on Wall Street.
Totally with you, Bramo. I think the big conversation we've got to have is the upside risk to rates in the second half, and that's something that Jan Hatzius and the team at Goldman were speaking to yesterday. Pleased to say that joining us now is Darryl Cronk, the Chief Investment Officer for Wealth and Investment Management at Wells Fargo. Darryl, always great to catch up with you, sir. Let's just start with those numbers from JP. Your thoughts?
Well, I think it's the first real indication you're seeing of both CEO confession season, right? Actually really looking at what the true impact of the earnings season that we've been kind of refusing to acknowledge in keeping these estimates high. And also the real impact, the first look at the real impact on what's happening with consumers at the pump, at the grocery store, right? The real effects of inflation and financial conditionings tightening at the warp speed that they've been tightening is going to show up in earnings. There's no place to hide on this, Jonathan.
There's no place to hide, Darryl Cronk. And in that is in a given sector, there will be winners and losers, even in a bear market. What is a distinguishing feature, say with the banks, that will be a winner in a bear market versus a loser in a bear market?
Well, I think for this earnings season specifically, Tom, it's a good question. I think when you are over-indexed to investment banking revenue, sales and trading revenue, I think that's going to be the challenge because, as we know all too well, the first half of the year, and in particularly the acute negative returns for both equities and fixed income markets in the second quarter are just going to make those returns abysmal, right, by any means. The traditional lending side, the consumer side, the small business side, has actually shown that it's been a little bit more resilient, although I think we're in the early stages of seeing some deterioration there. It just probably isn't going to show up as acutely in Q2. We need to watch for that in the second half of the year.
Daryl, based on the granular data, the real-time data, how much is JP Morgan accentuating something that we're seeing more broadly versus perhaps a unique story in itself with some specific misses and a stress test that really had some extreme scenarios? And that's sort of important given the market action we have right now.
It is really important, Lisa. And the point is, I think it is a telltale sign of something more broadly. I don't think it's idiosyncratic to them. I mean, if you just think about how rapidly the conditions have changed in the last month, I was on a few weeks ago, we were positive 14 basis points on 2 to 10 spreads. Today, we're minus 23. A few weeks ago, literally a month ago, oil was $123 a barrel. Today it's 94. Now that helps the consumer. The dollar is up another 4 to 5% just in the last month, right? Conditions are rapidly changing in front of our eyes. And I'm not sure people have kind of latched onto that and what it means for the second half.
Given that, Daryl, I'd love your take on the idea that we're seeing a really rapid build in credit card loans, and we saw that from Jamie Dimon in his comments about credit card spending and debit. How much does this indicate a challenge to the strong consumer balance sheet narrative?
Yeah, I think you guys hit it on the head earlier. I think the market has been sold a little bit of a bill of goods on how strong the consumer is. Let's admit that, you know, the support mechanisms through the stimulus of the pandemic really helped the consumer. There was large cash balances. Those cash balances are gone now. The savings rates have eroded. What's interesting, and you raise an excellent point, which is if you look at the Fed's data on consumer spending and credit card outstandings, right, increases there. We've seen some of the largest increases in credit card outstanding in the last couple of months that we've ever seen on record since we've been keeping data. That's an ominous sign heading into a world where the economy is slowing, financial conditions are slow or contracting, demand destruction's happening, and yet, to your point, the consumer's having to draw on revolving lines of credit in order to meet those spending needs at the pump and the grocery store.
Daryl, awesome to get your views on things. A lot happening this morning. Daryl Cronk there of Wells Fargo. Bank of America making moves. Michael Gapin arrives at the economics team, forecasts a mild recession this year. Savita Subramanian comes out and downgrades the outlook for equities. Their year-end forecast goes from 4,500 all the way down to 36. This just comes in from the rates team, just catching up with the team at Bank of America right now. We revise our US rate forecast lower following the shift to a recession call. They've got the 10-year end in 22 at 275, end in 23 at 250. And here's something that jumped off the page in the PDF to me. One important shift in the US rate view is on QT. Our base case is for the Fed to cease QT with the first rate cut in September 23. There's some big calls for the next 12 months in there, Tom.
Well, there are big calls around the big movements we're seeing, and I will say the floodgates were open yesterday by Bank of Canada. Let me make clear, John, that shocked me, and I believe it shocked everybody else in Wall Street. And that happens in any kind of a cycle and any kind of a set of historic events. There are these one-offs, these one announcements where you go, wow, I remember that. We had one of those yesterday, which is where you're going to start to see these seismic changes.
Lisa, Morgan Stanley up next.
Yeah, and how much they confirm the view that we heard from JP Morgan, especially because they're that much more dependent on the investment banking and the trading sides. This is a bleak moment, and a lot of people are changing their outlooks as a result.
Unreal stuff coming across the Bloomberg right now. Futures down 1.3 on the S&P 500. Yields up a couple of basis points on a 10-year. And JP Morgan, where's JP Morgan this morning off the back of this? We were down about 5% on the stock. I'll get the stock up on my Bloomberg terminal for you. This is what we look like right now. We're down by 3 percentage points. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Officials at the Federal Reserve may debate a historic 1% point rate hike later this month. Atlanta Fed President Raphael Bostic told reporters that everything is in play after U.S. consumer prices rose a faster than expected 9.1% in the year through June. Investors bet the Fed is more than likely to hike rates by 100 basis points at the next meeting. Donald Trump reportedly is looking at announcing in September that he'll run for president again. That's according to the Washington Post. The newspaper says that allies are telling the former president that announcing before the November midterm elections will drive turnout to help Republicans take over Congress. In Israel, President Biden and Prime Minister Yair Lapid discussed regional security and Iran in their meeting today. Afterwards, Lapid said he wanted to make sure that there would be no nuclear Iran, a sentiment that the president echoed. President Biden has said he remains committed to reviving the 2015 agreement that sought to limit Iran's nuclear activities. In the UK, another round of Conservative Party balloting is set for today. In the process that will determine the next Prime Minister, the field of candidates has now been cut to 6. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt have emerged as the frontrunners. At least one member of the field will be knocked out after today's vote. And there is another big name casualty from the $2 trillion cryptocurrency crash. Crypto lender Celsius Network has filed for Chapter 11 bankruptcy protection in New York. Celsius had amassed more than $20 billion in assets by offering interest rates as high as 18% to depositors. It halted withdrawals last month in the midst of a panic run by clients. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Inflation is too high, but we've started to see, especially in commodities, prices come down. And we've seen that in terms of oil and gas, but also in other commodities as well. They haven't come down enough. We want them to keep coming down, and we're going to keep taking actions to make sure that on things like prescription drugs, people are paying less going forward.
That was Wally Adeyemo there, the US Treasury Deputy Secretary from New York City this morning. Good morning. Here's your price action. We're lower by 1.25% on the S&P. We're down about 48. On the Nasdaq 100, we're down 0.9%. We're down 1.01. Yields look like this, up 3 basis points, 295.95. Crude lower again by 2.9%, 93.50. Bit of euro weakness out there. Let's just call it parity. I'm not going to argue over 0.0014 with you. We're at 1.0014 right now. We're down 0.5%. Dollar yen having a look at 139 and maybe more. Looking at 140 potentially. Dollar strength, the big story this morning. And in the mix, JP Morgan coming out a little bit earlier, about 40 minutes ago now. The stock recovering a little bit off session lows, was down 5%, it's now down just 2%. A few misses in the mix here, Lisa, and then suspending the share buyback program. Not exactly helping things out either.
No, and this really is a broader macro story. That's how it's being treated in the market. We saw new highs on DXY, at least going back more than a decade. We're taking a look right now at an environment that is shifting very rapidly. The fact that JP Morgan, in response to the stress test, said we need to batten down the hatches, prepare for the hurricane, and keep our balance sheet really solid tells you a lot.
TK, what's your take this morning?
My take is this: it's a time for a sea change. We see it in the markets, and frankly, I think we're going to hear it from James Dimon and his team today. John, Dennis Weatherstone was one of my heroes. This guy was a British guy who invented modern banking. There's no other way to put it. He's the one that took JP Morgan from the stodgy white shoe bank and brought him into the modern age. And he's the one that said, what risk are we taking? And Mr. Dimon has to pick this up now in these challenging times. And you see a year-over-year VAR moving from, I think it's a 40 statistic, out to 54, I believe, in the statement. Shanali's nodding her head, so I think I'm somewhat close here. But, John, the value at risk is not to be ignored as Mr. Dimon tackles this ginormous bank amid these market challenges.
Is that your gauge for whether you're right or wrong? You look out the corner of your eye and see if Shanali's smiling.
Yeah, it's like we got the Shanali cam. It's like the Bramo cam, but it's a Shanali cam.
Can we get the Shanali mic up?
She's on the
so
phone talking with all the hitters on Wall Street, and she's going like this. And,
Let's do that now. Shanali, there's a question that I've been asked this morning, and I wonder if you can answer it for some people in the audience. This decision to suspend the share buyback, how much of this is a Fed that spooked, looking at the stress test and telling banks, we're going to have some problems here potentially, get ready for them?
I think what's interesting is you have both the Federal Reserve worrying about the consumer credit, and you have Jamie Dimon also guiding that charge-offs can really rise into the billions in a year. You are seeing charge-offs start to rise here. But you know what's interesting, to Tom's point, you do have a little bit of strain here when you're looking both at the institutional side and the consumer side, and that's also concerning, John. When you look at that value at risk, actually the biggest jump was in fixed income. These are supposed to be safe, steady markets, and JP Morgan is a humongous intermediary at a time when liquidity is drying up. So you have to worry about that underlying strain as well as what's happening on the consumer side very rapidly.
John, I want to pick up on the point that you were talking about with what the Fed is worried about. And I think Neil Dutta said it perfectly just a few moments ago on Twitter. He said, behind door number one, the Fed raises rates enough to bring inflation down, but pushes the economy into recession. Behind door number two, the Fed fails to tighten enough and inflation expectations increase. When faced with this decision, the Fed chose number one, hands down, and that is the reason why it is a pivot point for this market as they look to a greater chance of recession.
The tail risk has become the base case, and the base case is now a mild recession. Now, we can have a discussion about how shallow or how long that recession will be for, but the ultimate base case is now that we get one potentially in the second half, and Bank of America are on board with that. And Tom, that's why you see a sea change from B of A this morning. At the epicenter of that research house at the moment is a call from Michael Gapin for a recession later this year. That means Savita Subramanian of B of A comes out, slashes the outlook for equities. No recovery there, 4,500 down to 3,600. Then you've got Mark Cabana and the team Over at the rate side of the business, Tom, basically saying the 10-year, year-end, 275. Next year, 250. Right now, 296.
John, I think you're going to see a lot more of this. And again, off of 100 beefs from Bank of Canada, it's a reset here. And I want to get very granular, John, on a Tuesday, Wednesday, Thursday hearing. You see it within the tension of J.P. Morgan. Shanali, I mean, we got the Shanali cam out here, and she's saying you got to work from halls here. Nobody's relaxing here, Shanali Bassick. They're going to work from the Hamptons. They're going to work on their holidays, etc. But isn't the age-old bank solution to cut costs? I mean, that's how you do this.
It's the oldest story in the world, John. Over hire and then over.
That's John. I'm Tom.
Sorry about that.
Okay,
yes,
continue,
over hire and then start to fire, and you are starting to see that happening at the more consumer-focused businesses. You're seeing it over in the mortgage business, but then what happens now to those investment banking businesses, guys? It wasn't just a little light on the figures. It was hundreds of millions of dollars worth of a miss. When you look at even debt underwriting, which is now about $700 million or so, that was inking more than $1 billion for JP Morgan just a couple of quarters ago. So the fates change very quickly here, and you've got to wonder what happens to talent in that kind of environment.
John, I'm fascinated what Morgan Stanley does. What is it, John, in 30 minutes or 15 minutes?
In the next 30 minutes, who knows, Tom?
Folks,
yes, sure.
For Global Wall Street, you've got to stay on this. This is a different JP Morgan report. And all of a sudden, I'm fascinated how Citigroup and Morgan Stanley, Goldman Sachs, and the others do.
A couple of things to pick up on then, Tom. In the next 30 minutes, we should hear at some point from Mr. Gorman and Morgan Stanley. Should hear from the president too, Tom. We've been waiting for that press conference with the Prime Minister of Israel, set to take place at the Waldorf Astoria in Jerusalem, Israel. Tom, that was set to start about 23 minutes ago. As you can see right now, still 2 empty podiums, so we wait.
Yeah, and it's all being choreographed very carefully here. And again, John, I can't emphasize enough the history here. I believe is today. There's so much going on here. My head's spinning of a president traveling to Jeddah on the Red Sea in Saudi Arabia on Air Force One from Israel. In my youth, John, I could not imagine that.
Next 60 minutes is busy. You will get numbers from Morgan Stanley. You will potentially hear from the president momentarily. At 8:30 Eastern, you get PPI, is it, Lisa, and jobless claims as well, and then Governor Waller a little bit later with Mike McKee. Talk about busy.
Yeah, talk about busy, especially with the jobless claims. We didn't talk as much about that, but this is also the big wild card. Could you see those jobless claims start to pick up in a big way? Not now, but perhaps in a couple of months when some of the areas that have built up capacity to respond to a sudden surge in demand have to suddenly cut back because suddenly they have overcapacity. We saw this with Walmart, with Target. How much is that going to create some pretty big swings in those unemployment figures?
Starts with hiring intentions, doesn't it? You saw that with Google.
Correct.
They alluded to that. You might see that in job openings a little bit more over the next several months, and then it's absolute job cuts as well. And that can happen pretty quickly, Lisa.
Well, that's the reason why I'm wondering if there is going to be some sort of tipping point there. And we talk about Delta, for example, not wanting to build up capacity even in the face of incredible demand because they are worried about just that, about being caught on the other side wrong-footed with overcapacity. And that, I think, is going to be a very choppy moment for the Fed to deal with.
John, to what Savita said,
yeah,
people get sorted out in bear markets. You know, it's Buffett in the water flowing out. Who's got the bathing suit on kind of thing. People are going to sort out here, given what we're doing and where we're moving, to the profit makers and the non-profit makers.
Do you know what I'd love to see? Lisa interview Ed Bastian of Delta, because Bramo loves to bring that up. You've got things to say.
How about
She's got things to say.
Look, we're running out of time.
We have. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City this morning. Good morning. Waiting for numbers from Morgan Stanley. Going into that, here's your price action. Equities down by 1.3% on the S&P. On the Nasdaq, lower by 0.9%. Call it 1 full percentage point lower. Here are the numbers from Morgan Stanley. Net revenue, $13.1 billion. The estimate, $13.33. Second quarter EPS comes in at $1.39. Let's get you some sales and trading revenue numbers. That comes in at $2.96 billion. The estimate, $2.94 billion. So basically in line there. Fixed sales and trading revenue, $2.5 billion. The estimate, $2.16. So an upside surprise there. Wealth management, net revenue, $5.75 billion. The estimate, $5.81. I suppose you can call that basically in line as well. Looking at some of the numbers from Morgan Stanley, looking at the stock, down by a little more than 3%. Tom, what do you see?
I see a different story than J.P. Morgan. It's much more focused, and I think I would suggest it is wealth management to the rescue on first blush. I just don't see the agony I saw immediately from J.P. Morgan. I'll be honest, the PowerPoint coming out moments ago, I got to dive into the PowerPoint, John. Talk about AC Milan football while I look at this.
1.07 billion. I'll just keep going through the numbers, Tom, against an estimate of 1.27 billion. Shanali can take a look at this now too. Shanali, your take on things?
Yeah, a few things here, John. One, you do have them beat on equities and fixed income, which is a strong showing from Morgan Stanley's trading desk. But remember also, you have JP Morgan bringing in more than $3 billion worth of equities trading revenue. So that is a stunning defeat, actually, for what is normally the biggest equities trading shop on Wall Street. But to Tom's point also, yes, wealth management to the rescue. You have net interest income coming in higher than expectations over at Morgan Stanley. We had talked about this before, the fact that the wealthier consumer may weather both the rising interest rate environment as well as the inflationary environment better than those who are not earning as much. It is kind of as simple as that.
Mr. Gorman, this line will resonate with pretty much everyone in this market year to date. More market volatile environment than we've seen for some time. I think we all agree with that particular take on things. Alison Williams joins us of Bloomberg Intelligence. Alison, I want your take on things, please. Compare and contrast what we got from Morgan Stanley against JP Morgan.
So I think the big differentiator this quarter might be capital. So Morgan Stanley has very healthy excess capital. For JP Morgan and some of the other big banks, they're feeling it from both sides. They're pressured by some of the bond valuations on their actual capital ratio, and then their requirements are going up. And that was sort of the big news that we got a few weeks ago, that JP Morgan, Citi, Bank of America requirements going up. So JP Morgan suspending their buybacks forecast today. We don't think that's a surprise. We think that's prudent, but perhaps might have been surprising for some. In terms of the trading and fees, one thing I'll point out on JP Morgan, they had a big miss on fees, but that was a leveraged loan write-down. Morgan Stanley may also have that, and it just might be sort of in another business line. Equities trading about in line for Morgan Stanley. That was a big surprise. So interesting that Morgan Stanley is the biggest in equities trading, and theirs is softer than JP Morgan, and the reverse is true on the fixed income trading side.
The stock, Morgan Stanley, down by 2.5%. We'll keep working our way through these numbers from Morgan Stanley. A couple of things happening at the same time. The President of the United States, alongside the Israeli Prime Minister, in Jerusalem, Israel, at the Waldorf Astoria. They'll be taking part in a news conference conducted right now. Any headlines, of course, we'll bring them to you. We want to stay on top of the bank story for you here on Wall Street, with equities down about 1.3% on the S&P. Lisa, Morgan Stanley, of course, not JP Morgan, and there are some big differences between the numbers this morning.
Yeah, and you do see some more strength in the Morgan Stanley numbers, even though they missed on a headline figure. It is notable the different profile of these two banks, and I keep going back to that. This is more of a traditional Wall Street bank, more in line with Goldman Sachs. How much are those banks going to actually do better than some of those that are more exposed to the consumer? And I do wonder, and I'd love, Allison, you to weigh in on this, how much are the consumer-facing banks, the JP Morgan, the Citigroups, the Bank of America, is much more exposed to downside surprise right now than those purely focused on the bread and butter of Wall Street?
I think that's right, because if you think about it, net interest income is strong for all those lenders, but that's sort of been a factor driving the stocks since last fall. And this year, really, the turn has been more towards the other side of things, the credit hit, loss provisions. We did see a reserve build at JP Morgan. It was a little bit more than people thought, but that's going to be in focus for all the traditional lenders, whereas Morgan Stanley and Goldman Sachs, that are more focused on trading in the capital markets units, should benefit more from that volatility. Goldman, however, I should note, we do expect to see sort of a big increase in their provision. Those estimates have been rising. It's just that as a percentage of their business, less exposure.
Allison, on the back end of it, they've got some dividend lift here and also a pretty general share buyback redo they're going to do. Allison, I want you to paint for our audiences, plural, those that are fancy global Wall Street and those less so, the absolute miracle of an unadjusted wealth management pre-tax margin of 28.2%. To me, that margin is a near act of God. How did they do that? How do they make that so damn profitable?
Higher interest rates. So if you think about the wealth and asset management business, the negative is that asset values are going down, right? So that means lower fees, but higher rates are a boost to the wealth managers, and especially Morgan Stanley with their acquisition of E-Trade really getting a lift there.
And I really can't say enough about it. And what I see, Allison, worldwide is everybody's trying to copy James Gorman. Am I right about that?
Wealth management, James Gorman is sort of an active buyer, but I would say, UBS and Credit Suisse tilting more towards it. UBS really, I think that they've been the story for a really long time. But in general, all the banks globally, to your point, trying to increase their exposure to this business. Keep in mind that this isn't just a cyclical help from higher rates, but the long-term story in terms of wealth creation, especially in Asia, is one of the few secular growth stories in financial services globally.
Morgan Stanley down a little more than 1% in the pre-market now. We're down by 2.7 on JP Morgan. Shanali, we've got a decent insight now across a range of businesses on Wall Street from two names, Morgan Stanley, JP Morgan. As we set things up now for Bank of America, for Goldman, for Citi, what do you see?
Yeah, a few things here. Boy, is that trading environment competitive when you look at what the setup is for Goldman Sachs. They have to beat on fixed income. They have to beat on equities here. You saw JP Morgan just blow it out of the water compared to Morgan Stanley. I don't remember the last time JP Morgan beat them in a quarter on equities. And Morgan Stanley as well, gaining share in fixed income. A few years ago, John, it was unheard of for them to be making more than $2 billion in a fixed income trading business. So that, and then of course also the pressures. You have asset management management also down meaningfully. In terms of revenue over at Morgan Stanley, both JP Morgan and Goldman Sachs, they are some of the biggest asset managers in the world. It is not immaterial if you do see declines in those businesses, even with, as Tom was saying, those blowout figures in wealth management beating on pre-tax margin when you exclude those integrated related expenses here. Of course, Goldman Sachs wants to take some of that crown in wealth management as well.
There is the parlor game and the horse race of who gets what business. There's a bigger story that's trickling out into markets as we see the dollar ascend and taking another leg higher on the heels of some of these reports, because there is a macro wager in holding back share buybacks and really building some of the credit loss preserves. And I wonder, Sonali, if you're expecting to hear similar stories from the likes of the Wells Fargos and the Citigroups and the Bank of Americas, whether they are positioned for a much more difficult next couple of months simply because they are that much more exposed to any potential recession bets.
Yes, and even a couple of weeks ago, before even that macro environment got even tougher, you started to hear them mute expectations. Wells Fargo will be extraordinarily interesting given their tie to the U.S. consumer and the mortgage market. Bank of America has been guiding that the consumer is steady, but will they share the same concerns about charge-offs that you're seeing over at JP Morgan? Remember, I have to say also valuation here. Morgan Stanley is committing to buying back $20 billion worth of stock while JP Morgan is suspending their buybacks, but Morgan Stanley is also more expensive relative to its book value when you look at the trading. And all of these businesses are still very, very volatile and subject to the macro environment.
Alison Williams, I'm looking at head count. JP Morgan, I believe, was a 260,000 number. Morgan Stanley, smaller, 72,000 a year ago, out to 78,000 now. Who are they hiring?
I think in general, the hiring we're going to see this quarter really relates to some of the campus hires coming on. You know, for Morgan Stanley, probably the bigger story, which I think Bloomberg has reported on, is mortgage banking. That's a business where we expect to see headcount coming down. In general, again, you pointed to the big employee base of JP Morgan versus Morgan Stanley. Keep in mind the branches that they have that really sort of fuels that higher staffing. That's a long-term story in terms of resizing those branches and becoming more digital and the like. I would say, the one thing that we're focused on as well this quarter with some of these global investment banks is the compensation pressure and what's happening with the investment banking headcount, because that's really where we saw a lot of pressure coming into this year. Record IPOs last year, record M&A. Obviously, that is not the story this quarter, and as we look to the second half and we listen for investment banking pipelines and what's happening with execution, we think there could be a little bit more softness there.
It's a very different year. Alison Williams, thank you. Alongside Sonali Vasa, we'll catch up with the two of them over the next week as we work our way through Wall Street earnings. Futures down by 1.4%. We'll push this forward now to a conversation about the economic data in America, 8:30 Eastern time. PPI data, factory gate, inflation pressure, all of that. Jobless claims we'll be talking about too. Just want to take us to Europe just for a moment. Take a listen to this for a headline from President Macron of France. They're saying we have to prepare for the possible cutoff of Russian gas, and saying that citizens and companies will need to reduce energy use. Tom, Europe front and center of a global recession call that is quickly becoming consensus.
And I would say, John, that's still true even with the EM upset today.
Subhadra Rajap is going to join us shortly, the head of US rate strategy at SocGen, off the back of a monster upside surprise on inflation in America. Futures down 1.4% on the S&P. From New York City with Tom Keene and Lisa Brambitz, I'm Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The U.S. Senate is getting closer to a deal on President Biden's economic agenda, but the state and local tax deduction issue threatens to spark a showdown amongst Democrats. Senator Joe Manchin has been negotiating with Senate Majority Leader Chuck Schumer. Manchin says the federal deduction, popular in high-tax states known as SALT, hasn't been in the mix. That could doom the bill's prospects. And the U.S. House has passed a bill to help state and local governments set up a warning system for active shooter situations. The legislation gained new urgency after shootings in Texas, New York, and Illinois. Many Republicans opposed it, calling it an encroachment on the rights of gun owners. A new forecast says the euro area's rebound from the pandemic will be weaker than anticipated. Meanwhile, inflation will be faster because of the war in Ukraine. According to draft projections by the European Commission, GDP is likely to rise 2.6% this year and 1.4% in 2023. Inflation is now seen averaging 7.6% in 2022. Amazon has moved a step closer to settle 2 European Union antitrust investigations. The cases have to do with how the e-commerce giant uses rivals' sales data and whether it unfairly favors its own products. The European Commission is now asking Amazon competitors for feedback on a proposed settlement. Amazon says it's engaged constructively with the EC. And Taiwan Semiconductor Manufacturing has raised its revenue forecast, but the predominant manufacturer of advanced semiconductors warned it will trim spending on expansion by as much as 9% from initial projections. That reflects uncertainty about electronics demand in the face of a possible recession. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
However you get your news.
This is Bloomberg Daybreak with links.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
If they need another 75 in July and 3 more 75 rate hikes by the end of the year, I think they'd be willing to do it. Do I think that's the appropriate pathway? Absolutely not. But I think in order to maintain credibility and try at least and get some sort of relief from prices, their hands are tied.
Who says one data point doesn't change anything? 9.1% shook things up big time yesterday. From New York City this morning, good morning. Futures down by 1.4% on the S&P. Futures down on the Nasdaq by 1 full percentage point. Yields in a single basis point. Curve inversion, the story. We'll pick up on that in a moment. I want to talk about Italy too. Do not take your eyes off what's happening in Europe. Your 10-year in Italy up 20 basis points. Your 2-year up 25. The prospect of this government led by Draghi to collapse. You've got Macron speaking like this just moments ago in a TV interview in France, the French president saying that we have to prepare for a possible cutoff of Russian gas. Citizens and companies will need to reduce energy use. Some of this climaxing next week, Tom. Nord Stream 1, of course, down for maintenance. That should come back on Thursday. We'll find out how much gas actually flows through Nord Stream 1. And then the ECB has got to somehow make a rate call. I've got no idea how they're going to do that.
7:48 Wall Street time and some real movement in the market, John. I want to notice further curve inversion. I don't believe we're through lows, but I'm sorry, negative 27. You know, we're halfway to Priya Misra in what, 4 days? I mean,
yes, she said negative 40 and maybe
we are.
lower.
And I'm also looking, I'm on the parity watch on Euro. We're still not through that 1.0011. John, I still think the American audience, including a dummy like me, needs to understand the stress of Mr. Macron. Rotterdam coal is up 710% off a moving average study back 2 years, I believe it is. Rotterdam coal, John, is up 103% since the Ukraine invasion.
I'd throw in the stress of Chancellor Scholz as well and Prime Minister Draghi across the board. For every European leader, a tough winter is the base case for so many people.
Correlations in place here with negative 52 on futures. The VIX out of stick 28.06. Subrata Rajappa now with SocGen joining us here. What is the correlation that matters to you right now, Subrata? What is the relationship not only in rates but outside rates for you?
Well, I mean, everything is a correlated market, right? I mean, the bond yields are all very correlated. What's happening in Europe is definitely impacting what's happening in the U.S. Inflation is correlated. It's a global phenomena. But what we're really seeing right now is sort of a wreck in slow motion, if you will, where in the U.S. you're seeing the steady rise in inflation prints, the Fed acting aggressively as predicted, and then the very sharp inversion of the yield curve because of that. And the market's starting to price in a much higher probability of a recession, that leading to potentially, Fed funds rate peaking around 3.5 to 3.75%, and then cuts being priced in for next year. So this is all very much what you would expect would happen in a scenario like this where the Fed is very aggressive. As far as Europe is concerned and the ECB is concerned, they're in a much tougher spot, like you pointed out. You're looking at, very high inflation, headline inflation because of higher energy costs, higher oil prices, potential rationing. But then on the other hand, they have to be concerned about growth as well, because if there is a shutdown of Nord Stream 1, that's going to lead to a significantly sharp decline in growth. So policy that becomes a lot more tricky than it is in the U.S.
We need to be building up gas storage in Germany. Apparently right now we're working it down. This is really problematic. Subhadra, more broadly for the bond market, I'm trying to work out what the anchor of global rates will be. Over the last 20 years, it was Japan, then it was Japan of the ECB and Europe and the bond market, and now there are doubts about the policy at the BOJ. Complete unknown when it comes to the European debt market. I've got no idea how you forecast European debt yields at the moment, Subhadra. How do you come up with the treasury call as you think about the global fixed income universe?
So to me, at this point, the anchor is the treasury market, because things in the U.S. are much more predictable, like you pointed out, than in other jurisdictions. Bank of Japan, they have yield curve control, so in some respects, the long end is going to remain somewhat pegged, but there's a lot of pressure on the currency side of the equation. So at some point, they're going to have to, move away from the peg in Japan. So for me, what I'm really anchoring our rate forecast is on the 10-year, and the trajectory for growth over the next couple of years. And that's really where I think that it's going to be very difficult for 10-year yields to rise meaningfully from here on, given the fact that growth is poised to slow down quite meaningfully over the next year, with the Fed expeditiously hiking rates over the next 3 to 6 months.
Subhadra, let's take that a step further and build on what Bank of America did, where they downgraded their forecast for the yield of differential and the baseline yields for 10-year and 30-year treasuries at year end and even next year. How low, and have you been revising even lower your expectations for those yields based on the deteriorating macroeconomic backdrop?
So our view for treasuries is that 10-year yields will peak sometime in the second or third quarter. We might have already peaked. And then after that, we have a very steady trajectory of yields going lower from here on after the third quarter, perhaps ending around 2.25% to 2.5% by the middle of next year. So that's kind of the trajectory we're looking at. It is quite a dramatic move lower in yields from where we are right now. But it's all about the trajectory for growth after the Fed has addressed its raised rates and address the inflation problem, if you will.
How much is this also hinged on the idea that the Fed will not be able to shrink its balance sheet materially beyond perhaps just the middle of next year, because they will have to backtrack in the face of volatility, in the face of recession?
Yeah, that's a very good question, because the whole policy framework gets very, very tricky this time around, given the fact that after September, the Fed's balance sheet is going to decline at around $95 billion a month. So that's a very rapid pace of balance sheet unwind starting as early as September. So, I think my view is that the Fed might be able to raise rates maybe to get to 3.25%, 3.5% by the end of the year. But then you're going to see the balance sheet runoff act as a second order effect, tightening financial conditions as well. So it's yet to be seen if they're going to be able to continue to run off their balance sheet after the middle of next year, given the fact that they're going to potentially have to cut rates if the economy slows down meaningfully.
Subhadra, awesome to get your views. What a morning for it. What a 24 hours. Subhadra Japa of SocGen. What a year it's been. What a few years. I'm sure some of you are screaming at the TV and radio as I say those words. Looking at these moves in this market, once again, we're seeing a simultaneous shift lower in a 10-year yield and a shift higher in a 2-year yield. And what you've got is a much more inverted yield curve. The yield curve now deeply, deeply inverted, going back to 2000 kind of levels, Tom, 210s through 25 basis points. And this idea that the Fed keeps going, and as they do, growth expectations keep coming lower.
Yeah, I had a banner out earlier, John. I don't think I've got it here now. But again, we have to say how rare this is. And John, for the first time, I can agree with you that the word deep is in order on inversion. And I put that as 0.25% differential, which is 25 basis points. We're now through that negative 26 basis points.
This is like herding cats this morning.
March 89, August 2000.
Futures down 1.4% on the S&P and the NASDAQ. We're down 1 full percentage point from New York. This is Bloomberg Surveillance.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It all comes back to this inflation story. The Fed hiking rates can only have so much of an effect on bringing price pressures down.
That is their key objective, getting that price stability.
Globalization is fantastic on the upside. It has the same downside effect. Everyone slows together.
There's no question there's going to have to be some pain here to deal with the problem.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television after J.P. Morgan and Morgan Stanley report. Market turmoil, and John, we saw it in those earnings reports.
J.P. Morgan is preparing for tougher times, and I would argue, many people would, this market is adjusting to that reality as well. You see that through the yield curve, 2-year yield's higher, the 10-year yield is lower. You see it in the commodity market too. I think this isn't being covered enough. The breakdown in copper, down another 1.3%.
Yes.
The breakdown in crude, WTI down another 2 percentage points, 93 handle a little bit earlier this morning. All of a sudden, Tom, the tail risk becomes the base case.
And what's so important here, John, is we think as hard as we can, and we've got equities, bonds, currencies, commodities, all of our wonderful guests in front of it. You had Jean Boivin, I believe, John, yesterday. I can't remember. Expect the unexpected. Bank of Canada change this market.
New regime. That's what Jean Boivin is looking for. He expects that to come with higher volatility, perhaps lower returns, but ultimately higher interest rates and stickier inflation. That's what it comes down to off the back of the report yesterday. Do you look at that report as evidence that we've seen the worst of this? Energy's going to fade, that headline number's going to come down. Or do you look at that report as evidence that this is going to be stickier, broader, and this Fed's going to have to go a whole lot higher for a whole lot longer?
I mentioned Rotterdam coal. I looked at Netherlands natural gas. And there's any number of tensions we can focus on, folks. Let's not turn this into a lecture. But, John, Europe is still very visible.
Without a doubt. Let's just call it parity on euro dollar. That's not the new development.
Fair, yeah.
Here's the new development. In the Italian bond market this morning, yields are breaking out. Spreads are wider, and we need to talk about the why. The prospect the Italian government collapses. We go into next week with Nord Stream 1 down for maintenance, set to reopen, and a complete unknown as to how much gas is going to come through that pipeline through the rest of this year. And European leaders coming out this morning, President Macron saying citizens and companies will need to reduce energy use. That is the dire straits that Europe finds itself in this year.
In this hour, Lawrence McDonald will join us. I can't say enough about this. Lisa Abramowitz, Larry McDonald is really, really focused on emerging markets. I don't think Italy's an EM, but it's got those characteristics, Lisa, that you see in Egypt and others.
Yeah, although I wonder if that's going to be the story or if it's going to be continuation of Europe really dragging down the rest of the world and acting very EM-like in terms of how volatile some of the inflation backdrop is. I just want to build on this idea of the gas issue. In addition to what we heard from Emmanuel Macron, the fact that German gas storage levels are falling before we get into those peak usage months at a time when people are worried about the gas supplies being cut off, really raised the specter of Germany coming out with something similar as Emmanuel Macron and saying, stop using so much, put on a sweater, you know, keep temperatures at this level.
Right now, it's 2-10 spread, negative 27 basis points. In honor of Alan Greenspan and a measured Fed, John has a measured headline.
Andrew Hollenhorst from Citi. Here's the change. We now see a 100 basis point policy rate increase at this month's Fed meeting as the most likely outcome. They published just moments ago. In June, the committee showed it will react to each monthly meeting, each inflation reading. We now expect policy rates to reach 4% by the end of 2022. So here's the call from Citi, I'll repeat it. 100 basis points this month from the FOMC and policy rates to reach 4% by the end of 2022. And let me remind you something a few months ago. When Citi came out with that call for a 50 basis point hike, then another, then another, then another, a lot of people laughed and pushed back. Then it became the base case about a month later. And then things went even further. So this Citi call this morning, Tom, 100 basis points. Worth remembering that the two banks that are now calling for this, Nomura and Citi, they've been out front on this tightening cycle in a way that others have not.
John, very quickly here, are we simply prepared for 4%? I would suggest we are not.
I don't think we are either, Tom.
It's just that simple. On the data, John, let's get through this quick because Victoria's been patient to wait. Futures deteriorate negative 40 before JP Morgan. They come down to negative 57 now with new lows. Dow getting near negative 500. The VIX out of stick 28. What do you see, John?
We're down 1.5%. We see further curve inversion. 2-year yields higher. The 10-year yield a little bit lower. We're seeing that again today. 292.62 on a 10-year. And I mentioned that breakdown of crude. We should go there again. Tom, 93.92 on WTI. We're down another 2.5%.
Deterioration in EM, even if someone like the Philippine Bank steps in with a rate increase. Within this tumult, Victoria Fernandez joins us, Chief Market Strategist at Crossmark Global Investment. Victoria, what should mere mortals do here?
Well, it's tough, Tom, because I think there is so much confusion out there right now. I mean, you guys have rattled off all these different things that are going on right now. We've got highest inflation numbers we've seen in decades, but yet at the same time, we've got 10-year yields falling. We've got 5-year and 10-year break-evens at their kind of historical averages. And so it's this concern of, in my opinion, more what we're going to see the ECB do next week. I think that's going to flow through and really cause some volatility in the markets. When you're looking at all of this, what we're doing with our clients is really just trying to nibble a little bit here and there in the markets to balance out our portfolio. We've pulled back on some of our value names. We've added a little bit of growth, but it all comes down to quality, Tom. With earnings season here, you need quality of earnings, quality of balance sheets. We looked at the balance sheets with the banks this morning. This is where you've got to focus. So we've actually done some names like Waste Management. We've done some names like General Dynamics that have those features associated with them.
Victoria, has the past week and what we've seen in terms of the CPI and now what we've gotten from JP Morgan caused you to increase your view of where we are in the cycle? In other words, are we halfway through the sell-off? Are we 3/4? Or are we almost there?
Yeah, I've really kind of shifted my thought a little bit, Lisa, over the last week, more in the terms of I do think that recession is probably a little bit sooner rather than later compared to where I was before. When we've talked recently, we were looking at second half of next year for recession to come in. I think that's been brought forward, again, a lot of because of what we're seeing in Europe. We have the Fed here that has said they're going to do whatever they need to do for inflation. I mean, I don't think they want to do like a Thelma and Louise and drive us off the cliff, but I think they're willing to go right up to the edge in order to bring that down, and that's going to affect growth. So I think we have to be prepared for that. I do think it's interesting, however, in the JP Morgan release, Jamie Dimon said consumer spending was high and the ability to spend was still strong. So I do think we have some counter trends at work that perhaps means if we go into recession sooner, it won't be a deep recession.
There is a consensus building this week, Victoria, about going into duration, going into long-dated bonds, because whatever the trajectory is in the near term, the long term is lower inflation and lower growth. Are you piling onto that?
So we've actually been extending our duration in all of our fixed income strategies. We've been short duration for a long period of time, and that's worked really well for us over the last year. We're not going long versus the benchmark, but we are getting closer to neutral from where we've been. And I think that's the best way to play that right now. So you give yourself the room to go shorter or longer, depending on what you're seeing develop over the next couple of quarters, but you're seeing more and more of that. I think people realize longer term, like you're saying, yields will be lower. 270 on the 10-year is kind of that level we'd be watching that we think will stay above. But we called for a high of between 3 and 3.25 on the 10-year this year. Obviously, we went above that a little bit last month, but yet I think that might be where we end up at the end of this year.
Victoria, awesome to get your views on this show. As always, Victoria Fernandez there of Crossmark Global Investments, working through some really interesting calls on Wall Street. Wall Street adjusts in a major way. We talked about Bank of America. It started with Michael Gapin looking for that recession in the second half of this year over at Bank of America. Savita Subramaniam had to adjust to that. She's now looking for 3,600 on the S&P, down from 45. Then we get this call from Citi, Lisa, a 100 basis point hike in July is the most likely outcome. And I think the bigger call here, and I said this a little bit earlier when we started the program, it's not about 75 or 100 at the end of July. The bigger call here is whether you think this Fed has to go a whole lot further for longer. They've got the Fed at 4% by the end of 22. That's much more important, Lisa, as to whether this Fed goes 75 or 100 month end.
And embedded in that comment is that going to be the end? Is this front loading? Is this aggressive front loading to bring things down quickly? Or is this the beginning of something that they are concerned is more protracted? And that, I think, is also a huge discrepancy when you talk long term, especially when you talk about long dated bonds and the conviction into duration.
John, I think the Fed parlor game yesterday stopped. I don't know what else to say. What I'm looking at in the market here, particularly the way that yen is deteriorating, is we come much more into a correlated global moment where gaming a given central bank, when are they going to do this, when are they going to do that, is really not part of the analysis.
Well, tell me what the BOJ is going to do in response to some of this, Tom, because maybe that is...
Well, there's a bet there, and there's people smarter than me looking at that. But the bottom line is, find me somebody that believes yield curve control in Japan is a valid, doable process, key phrase, over time. Nobody believes that. And when does it break is the arch question.
Lisa, can they resist what's coming? Another 100 basis point move at the front end.
Can they resist what's coming as you do see the dollar ascendant? That, I think, is the key question. Or do they have to wait till some of that pressure comes off for them to actually capitulate, to show that they're doing it on their own terms? And that's been the idea, but at a certain point, the levels become very difficult for them. And are we getting to that point?
It feels like 5 minutes ago we said, can we break 107 on the dollar index and then 108? And Tom, we're staring down the barrel of 109.
We're looking
right
at
now.
This is really important, folks. Dollar index 107, 108, 109. That's major trading. Europe's 54% of it or something. The BBDXY shows the same tension today, John, and that's the folded in EM tension as well.
I'd like to hear from the big multinationals, the tech names with decent exposure to Europe.
Yeah.
With the 1-2 hit coming from a weaker economy. And just a much weaker euro in the face of some of this. Futures are down 1.5% with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Officials at the Federal Reserve may debate a historic 1% point rate hike later this month. Atlanta Fed President Raphael Bostic told reporters that everything is in play after U.S. consumer prices rose a faster than expected 9.1% in the year through June. Investors bet the Fed is more than likely to hike rates by 100 basis points at the next meeting. Donald Trump reportedly is looking at announcing in September that he'll run for president again. That's according to the Washington Post. The newspaper says that allies are telling the former president that announcing before the November midterm elections will drive turnout to help Republicans take over Congress. In Israel, President Biden committed to extending an agreement that provides billions of dollars for the Israeli military. He signed a joint declaration with Israel's Prime Minister Yair Lapid. The document also says the two countries will never allow Iran to acquire a nuclear bomb. And in the UK, another round of Conservative Party balloting is set for today in the process that will determine the next Prime Minister. The field of candidates has now been cut to 6. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt have emerged as the front-runners. At least one member of the field will be knocked out after today's vote. A dispute has erupted between London's Heathrow Airport and one of the biggest airlines in the Middle East. Emirates rejected Heathrow's demands to cut capacity and says it will operate flights as planned. The carrier flies 6 Airbus A380 Super Jumbos to Heathrow every day. Emirates says Heathrow isn't giving it enough time to rebook travelers onto other flights. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This report reflects that inflation is unacceptably high. Our economy looks well positioned to deal with the challenges faced by the Fed attempting to cool inflation and Russia's war against Ukraine. And we are really going to be hoping that the Federal Reserve can pull off this soft landing.
I'm looking at that and I have to laugh. It's over to you, the Federal Reserve, to engineer the soft landing and bring inflation down. We'll give them the space to do that. That was Cecilia Rouse there, the chair of the White House Council of Economic Advisors. A lot to talk about in this market. Let's do that and avoid the politics. Futures down by 1.4% on the S&P. On the NASDAQ 100, we're down by 1 full percentage point. The latest from Citi, they look for a 100 basis point move on the Fed funds rate month end, and they look for 4% year end. There are some massive calls out there at the moment. Your 10-year, 293.92. Crude lower by 2 full percentage points right now, 94.28. We need to talk about JP Morgan as well. Jamie Dimon on the earnings media call right now saying inflation might be higher than you expect. The stock is lower than some people were looking for this morning. We're down 3%. Earnings miss, suspending the share buyback, preparing for bad times ahead. Basically, Jamie Dimon also saying, Tom, that if we get those bad times, the consumer is strong enough to withstand some of that pain. So that's the latest from JP Morgan and the earnings call.
Focusing on the correlations now, just because of the shortness here, we'll get to this later. Substantial markets on the move right now. John, I've got to go to 2-10 spread, which moments ago was a negative 27 basis points, 0.27% percentage points difference in the 10-year and 2-year. What's your single statistic, John?
The theme over the last 24 hours, I'm looking at the same thing from the yield curve, Tom, is 2-year yields higher, 10-year yields lower. And Lisa's talked a lot about it. I'm on the same page as Lisa here. Yeah. That is the prospect of higher Fed rates ahead and a prospect of slower growth in our future.
Let's take what we see in the correlations of the market and go to the single correlation for Washington, which is no one's getting paid anything given this high inflation. It's the real wage reality that all of Washington faces. Andrew Blocker has spent years looking at this. Ec 10 told him at Harvard years ago, guess what? Jobs matter, the wage matters. He is with Invesco as global head of public policy. Andy, what is the urgency this time around of a horrific negative real wage?
Well, politically, it can be death for politicians. So right now, we talk about the economy always being the most important thing. Well, inflation is a major part of the economy that talks about how people actually live every day. And so with this latest spike to 9.1% and us not seeing the top soon enough for the November elections, I think it can have a real impact on what's happening in the midterm elections.
I guess the suits and ties will tell us that a higher unemployment rate is good for us right now. Explain that to the American people. How does Mr. Powell, frankly, how does President Biden sell a higher unemployment rate is good for you as we bring inflation down?
So, of course, you give me the tough task here, but theoretically, the thought would be a higher unemployment rate would actually soften wage inflation, and which can be the core of inflation. So they're really focused on getting down inflation and if you're just looking at it from an inflation perspective, it could be good. But the other side of it is it's an economic downturn potentially. So they are really trying to walk that fine line. And as you've seen, you guys have been talking about, we've had the 75 basis point increase. We're looking at a full point. This full 100 basis points, this is a tough place to be right now, and I'm just glad I'm not working at the Fed to try to navigate this.
Meanwhile, in the here and now, we're trying to parse out the rhetoric of President Biden and some of his associates with what they actually are planning to do with respect to going after companies that they are accusing of price gouging. I'm thinking of oil companies, for example, but I'm wondering who's next, considering the fact that places like airlines are not increasing capacity in the face of increasing demand. How much is this going to be a reality? Is there meat behind some of these threats versus just simply lip service?
Well, there's only meat behind the threats if there's actual malfeasance. So, I mean, that remains to be seen. Look, the administration right now is in the toughest of all worlds. They have high inflation. They have a potential recession on the horizon. They have people really feeling the pain, and so they need to make sure that they are out there looking at every lever they can, pulling every lever to help make things better. And so, whether it's going to Saudi Arabia, which we've heard that may not be about oil, but we know it's a big part of it is oil, or whether it's going after companies in the U.S., they're trying to pull every lever to make it look like they are doing everything they can for the American people.
And when they have no more levers, Andy, they say, look to the Fed. They're going to do everything. It's their job. How politicized right now is the Fed?
Well, the reality is the Fed's been politicized for some time, and I don't want to go too far here, but I mean, we've gone from a dovish Fed, who many people think were late to the inflation acknowledgement, maybe saying it was short term, to now where they are really kind of putting on the gas to raise rates. And to say that politics didn't play a role in both being dovish at the beginning and now being hawkish, I think would be missing the point.
Andy, so well said there. Andy Blocker there of Invesco. The White House put out a statement yesterday off the back of the inflation report, and Lisa, at the end, it said, we will continue to give the Fed the right space, or something like that, to bring inflation down. And we all read between the lines there, didn't we?
Well, there was also other nuances that were pretty interesting in that statement, including their focus on core CPI. The Fed basically has come out and said headline CPI is actually more important this time around. We've seen that in a number of anecdotal reports around the edges. And then the president saying, but look, core CPI is coming down, so that's good. He also talked about how this is backward looking. I mean, suddenly it's the economist, the chief economist in the White House, as he tries to soften a pretty bleak message.
I think you can thank Brian Deese, the National Economic Council Director, for some of those speaking points, perhaps. Euro dollar's been breaking down 1.0006. That currency pair is negative about 0.5%. When we broke parity yesterday, the ECB had this for a statement. The European Central Bank does not target a particular exchange rate. However, and this is classic from a central bank. However, we are always attentive to the impact of the exchange rate on inflation in line with our mandate for price stability. In other words, Tom, let me translate. This euro's weak, and it's making our problem with inflation a whole lot bigger.
David Malpass, now at the World Bank, was very articulate about this. John, you have a depreciation. It all gets rationalized by the fancy people in bow ties. Guess what? None of it matters. You're poor. That's all there is to it. John, I've got to look at the hallmark here, rounded up. Bloomberg Dollar Index right out near new record level with that EM weakness. And John, I would suggest a 1,300 on BBDXY. That's somewhat equivalent to Dow 10,000.
Where's the Dow now, Tom?
Dow is 30, it's down 500 points earlier.
It's instructive.
30,290. It's down 500.
If I wake up and someone says the Dow's down like a couple of, that means nothing to me. What does that mean to anyone?
All of America, it's a big deal.
But if you went to sleep for 20 years and woke up, it's a much bigger deal, isn't it? Because we're obsessed with Dow points. I mean, what is it?
It's American. It's an American thing, John.
Tom, I think you underestimate the knowledge of some people in these markets, that they've moved away from that. There is a reason that the whole of Wall Street does not offer Dow forecasts. They don't. Do they? And you know that.
Well, no, I think
don't. Who offers a Dow forecast year end? Name the bank.
I'll have to go look.
Go look. We're down 1.4% on the S&P. From New York City, Tom Keed, Lisa Bravis, and Jonathan Ferro. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
For those of you interested in sending me abuse on Twitter, perhaps, about how important the Dow is, Twitter's down.
Yeah.
So maybe wait, or, I don't know, find me on LinkedIn, send it there.
Can we blame it on Elon?
Maybe, Tom. Got no idea. Lisa, what's the story there?
Basically, just there have been a number of usage outages reported for thousands of users, that according to a couple of different reports, and it just has an error screen when people log in.
So we can't moan about PPI on Twitter this morning.
Correct.
We can do that with Mike McKee, though, right here on Bloomberg TV and radio, breaking the economic data. Mike, what do you see?
We're going to have a lot of people moaning today about a 100 basis point move because PPI comes in hot as well as the CPI did. Final demand month over month up 1.1%. That's an increase from the prior month that originally was reported as 0.8. The ex-food and energy category comes in up 0.4. That's a little bit of a decline. Much of the PPI for final demand comes in hot because of energy, they say. On a year-over-year basis, we're at 11.3%. That's up from 10.8. So that's a kind of scary big number. Jobless claims, big jump, it looks like. 244,000 are filed. That's compared to 235,000. And I'll get the prior month week's revision in here if I can in just a second. It's an increase of 9,000 on the month. So that this set of data are not going to be well received by folks on Wall Street, and I bet if you check the bond market now, you're going to see a reaction.
I see that, Mike. You know, folks, I just did a moving average study here, claims, and my single number is just arbitrary, is 207,000. Mike McKee, when do we blink on claims moving from an arbitrary 207,000 up to 244,000?
Well, we're probably going to take a while, Tom, because it is such high-frequency data. People want to make sure that it's not a one-off or some kind of a fluke. But if we get a couple more weeks where we see these kinds of jumps, then people are going to get nervous about it. Now, this is July, and July is when a lot of auto plants shut down for retooling. So historically, there is a seasonal adjustment problem here. The retooling weeks are different each year, so it's hard for them to account for that. So it may be that this is just an unusual situation where we're seeing people on temporary layoff. But if this is a trend that continues, obviously it's something that's going to worry the Fed.
Mike McKee, thank you, sir, and looking forward to your conversation with Governor Waller. Yes, later. And I have to say, Mike, there's no one better to do it. Tom, Mike's going to sit down with Governor Waller a little bit later today. Lisa, what time was that?
That's at 11:30 a.m.
11:30 a.m.
Really important. Let me sell
Couldn't agree
Waller.
more.
Waller's out of St. Louis, John. When they reinvented statistical and research analysis, St. Louis led the way, and Waller is a distillate of that. So I'm really looking forward
Very cool, Tom.
To that as well. Right now, Conrad de Quadros with the Senior Economic Advisor at Breen Capital, and this is the conversation of the day. If you're worried about where that so-called terminal rate is, there's 3.5. John Farrow just mentioned 4% at a given bank. Okay, you outdo them all. What happens to us if we go to a Breen Capital 4.5%?
Well, maybe we make some progress on bringing inflation down. I mean, obviously the problem of the day right now is inflation. We've had over the course of the last 2.5 years a number of poor narratives on inflation, right? We started with COVID's going to be disinflationary. That went for 6 months with economists and the Fed. Then it's inflation is going to be transitory. It's only in a handful of goods. We saw in yesterday's CPI report that it's neither transitory, obviously, and we have very broad-based increases. I mean, it looks to us like underlying inflation is somewhere in the neighborhood of 5% now if we look at those trimmed means and medians and sticky price measures. So the problem of the day is dealing with inflation. And you raise a very important point on that terminal Fed funds rate. And the idea here from the Fed is to get policy to neutral and maybe a little bit beyond neutral. But the problem is I think they're misjudging neutral. The 2.5% neutral rate is a neutral rate that existed when inflation was still at 2%. We're not at 2% anymore, and it's a nominal rate. So that neutral rate is probably higher, and I think the Fed has got some work to do to get policy tight and bring inflation down.
The terminal rate, 4.5%. The path to get there is important to understand. Is this a front loading? Is this a rapid rate rise of 100 basis points at several consecutive meetings? Or is this a gradual and steady, painful drip, drip, drip of let's get it up there because it's not coming down when we look at inflation?
Well, Lisa, I think that the Fed will take what the market gives it, and right now the market is giving the Fed basically a green light to go by 100 basis point at the July meeting. So unless that changes before July 27th, I think the Fed will take that. They've told us that they want to get, as you said, they want to front load these moves. They want to get the funds rate to what they think is neutral and maybe a little bit beyond. And as I said, I think that judgment might be off. I think that the neutral rate is probably higher. I mean, if you think about it, if you look at the Fed funds rate and put it in real terms, it's still significantly negative. And I don't know how we bring inflation down with negative real rates.
Conrad, when we take a look at some of the data that we've gotten this week, we've gotten the CPI, we got JP Morgan earnings and Morgan Stanley, and now we have PPI and perhaps more importantly, initial jobless claims coming out higher than expected, rising more than expected. Can you put into perspective how telling that is versus perhaps noise and data that has been pretty noisy?
Yes, and I think that's the jobless claims are important. It's a very high frequency indicator of the labor market, as Mike pointed out, and I think this is a very important point that July is a difficult time to read jobless claims because of those auto shutdowns. And we had an announcement a couple of weeks ago from one of the large auto manufacturers that they're shutting down production until September, and that's related to shortages of parts. But if we take a broader view of the labor market and we look at things like job openings, whether it's the BLS data on job openings or small business job openings for June, which showed 50% of small businesses surveyed reported a job that they could not fill. The record high, and we have data on that going back to 1973, the record high was 51 last month. So we have very high levels of job openings. We might see some pickup in layoff rates, but right now, if we look at the broader data or the small business data, it looks like there are a lot of jobs out there to fill. So as people lose jobs, I think there'll be opportunities to get jobs in with other firms.
Conrad, long ago, there were research reports that would come out, and there was a young Turk named John Writing, who you have a nodding acquaintance with, that would write about tumult, like 1998. I remember this very clearly, waiting for Elliot Platt's book and all of it, and all the research from Bear Stearns and DLJ and such. Are we back there now? When you look at the correlations out there, the deterioration in EM, 2-10 spread in a heartbeat down to 27 basis points an hour ago, are we getting back to that kind of tension in the global system?
Well, I think one of the things that we're trying to adjust here is to a market that is more on its own. It's less being influenced by the Fed in terms of its balance sheet, right? So we have the Fed that's begun the process of normalizing the balance sheet. I think that that's had very important implications for the functioning of markets, and it raises other issues, right? In my opinion, we can look now at the Fed's shift in its monetary policy framework to flexible inflation average targeting and say that that's been a disaster for price stability. But I also think the other issue we have to deal with is we've had over the last 15 years or so a shift in the Fed's reserve policy, and this relates to markets. And the Fed has shifted to an ample reserves policy, but with tight regulations on bank liquidity. And I think that we're going to have some stresses to deal with as it begins to reduce its balance sheet, as forward funding rates are now a lot less certain. If you think back to late May and you told people that SOFR, for example, would be 2.5% at the end of July, or approximately, that would have been a shock, right? So there's a lot more uncertainty in funding rates. The Fed is pulling back on the size of its balance sheet, and aggregate liquidity is still very high. But we've learned over the last few years that liquidity doesn't necessarily get to markets that need it. And so we've had these policies. We had the blow up in the Treasury market in March. I mean, these are some of the issues that we still have to deal with, and I think are still out there given the Fed's reserve policy.
Conrad Quadras, thank you so much. We have to go to some breaking news here, but greatly appreciated. John, Mr. Diamond's rationalizing the world.
He is, and Sonali Basak is listening in on the earnings call with the media. This is what he had to say about the regulator. The regulators had a new test, which we don't agree with, but they had it. It puts you in the wrong time, reducing credit in the marketplace and reducing buybacks. For those of you just tuning in, JP Morgan suspending the share buyback program. Got some insight from the CFO as well on this call, Tom. This is pretty interesting. Consumers still don't feel so pinched by inflation that they're cutting back on discretionary spending, and that's a relatively positive sign. That from JP Morgan. The card spending data from B of A spoke to a little bit of a different picture based on what's been happening with gas prices. But here's a headline on gas prices from the CFO. The average consumer spending on gas is up 35% year on year. That's the number from JP Morgan. I can fold in the card spending data from Bank of America to give you a bigger picture. For the low income cohort in America right now, they're spending about 10% of the wallet, Tom, on gas alone.
Well, there's that part. I think that's very true. And on the EM basis, of course, it's so much food as we see in Egypt and Sri Lanka. But John, what to me is so important here is a decile analysis of the effect of whatever kind of recession you want to call it. Even a growth recession, it affects so many different parts of America in unique ways. You know what? The haves are still spending. No question about that.
What do you make of that headline, Lisa, that Sonali just sent me over, listening in on that call with Jamie Dimon? The regulators had a new test, which we don't agree with, but they had it.
Basically trying to say it's not that we're so gloomy, and then trying to paint it a little more positive by saying consumers still look like they're spending, which helps them in terms of increasing some of the loans. I mean, let's just call a spade here. If you take a look, though, at the Bank of America issue and the credit card data, it also is confirmed in airline travel, and even the CPI report that we got yesterday, where that was actually one area where prices came down. And there are signs that airline travel is starting to decline in the face of some of these higher prices. So it's clear that there has been some sort of offset from the higher gas prices and from the inflationary winds themselves.
Delta, you want to say something about Delta? No? Okay, no Delta. Lisa's got thoughts. Everyone knows Lisa's got thoughts.
When you talk about whether people are reducing travel, is it for the experience? Is it because of the price?
Getting stuck at an airport somewhere you don't want to be.
Are we ready for Conrad DeQuadras' world of 4.5% terminal rate?
I don't think so, Tom. I mean, Citi were talking up 4% year end. Futures are down 1.25% on the S&P. TK, I'm taking a day off tomorrow.
Oh,
it's you and Lisa.
I did not know that.
All day on Bloomberg TV and on radio, and all night apparently too. I'll catch you with you next week. TK, because I love you, this is for you. The Dow, down 438. All right.
There we go.
That's my goodbye gift for a long weekend.
Anaconda Copper, 34 3/8.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The U.S. Senate is getting closer to a deal on President Biden's economic agenda, but the state and local tax deduction issue threatens to spark a showdown amongst Democrats. Senator Joe Manchin has been negotiating with Senate Majority Leader Chuck Schumer. Manchin says the federal deduction, popular in high-tax states known as SALT, hasn't been in the mix. That could doom the bill's prospects. The U.S. House has passed a bill to help state and local governments set up a warning system for active shooter situations. The legislation gained new urgency after shootings in Texas, New York, and Illinois. Many Republicans opposed it, calling it an encroachment on rights of gun owners. Sri Lanka's President Gotabaya Rajapaksa has arrived in Singapore after fleeing protests in his own country. Singapore says he has not yet asked for asylum. Rajapaksa missed a Wednesday deadline to submit his resignation. There have been months of protests in Sri Lanka over soaring inflation, shortages of food, fuel, and medicine. In Manhattan, apartment rents soared to another record high last month. The median for a new lease, $4,050. That is 25% higher than a year ago. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Competition for Manhattan apartments is fierce and is expected to get even more intense in the coming months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Why Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
On whether we get back to, call it 2%, 3%, that's not likely to happen before 2023. And in our view, we do hover around that 2 to 3% range, which we do think the Fed will ultimately accept as the new normal.
Mona Mahajan there on where we are in these markets. And I guess, Lisa, there's a little bit of a breath here. I mean, we had negative 27 beeps on 2s, 10s. It's a little bit better, but I'm struggling here, Lisa, in a day of significant tension.
The story of the week to me is the dollar, at least in markets.
Yes,
it is a dollar
totally
ascended. And right now what that is telling us is that the Fed is going to have to hike rates, but more importantly, that there's so much uncertainty globally that is the only haven that people really are finding respite in. And it is one that is highly concerning for a lot of places in this world.
Long ago and far away, Lehman Brothers was a shop that excelled in the fixed income trading market. When Lawrence McDonald worked there, he made them some money. He went on to do all sorts of other things, including books and, of course, the Bear Traps Report. But what he's really known for is every once in a while writing an essay where in a given year you stop. He did that this morning for the esteemed Zero Hedge. Larry, first thing I read this morning as well, I've been talking up Tunisia is something interesting in the Middle East and in the Levant, and you are focused on the fixed income deterioration of emerging markets. We've seen this before, haven't we?
Oh, Tom, it's amazing. This period that we're in right now is so amazing because once or twice a decade, maybe even 3 times in 20 years, you get a 2, 3, 4 week period where asset prices are moving at an accelerated pace so fast.
Right.
And normally economists that are on all the shows, they're looking at economic data.
Right.
But when risk assets are moving this fast, the risk assets take over economic data.
The difference here, Larry, the difference here, and this is really important, folks, is an immense esteem for Lawrence McDonald. While everybody else in the bow tie world was studying economics, McDonald was down at the Brothers Four in the Casino by the Sea on Cape Cod having a good time where he learned how to trade. And as you know, Larry McDonald, what this is about is the bid walks away. You've got a Bloomberg terminal behind you there in your manse. Explain to me right now the character of the bid walking away right now.
Well, it's the rate of change of asset prices, whether it be leveraged loans, emerging market bonds, credit default swaps on banks. So we're seeing just the highest acceleration in the rate of change speed. It's literally as fast as COVID, as fast as Lehman. And economists around the world are looking at, okay, all these rate hikes. At the end of the day, credit risk is about to veto the Fed's policy path. In other words, the dollar is so strong, it's the global wrecking ball. The IMF, for example, is owed $100 billion, Tom, from emerging market countries. And the Fed is lighting that balance sheet on fire right now.
Well, but Larry, I'm trying to wrap my head around some of the rhetoric, which is incredibly poetic and describes the moment. Credit risk is about to veto the Fed's tightening path, that risk assets are taking over for economics. Basically, we're reaching a breaking point akin to a Lehman moment or even what we saw during COVID. Are you basically saying the Fed will have to backtrack, or are you saying that there is a more material fissure that's coming that's really irredeemable given where the Fed is with inflation?
Well, think of, you've done a great, Lisa, this morning, your job on the stress test has been phenomenal because if you look back on late June, the results came out and the media was really celebrating these results. And now here we are, not even 3 weeks later, and there's a restatement of those results. That tells me that the regulators saw a shock. Something is really scared the regulators for that type of change in position over 30 days. And if you look at the rate of change in bonds, copper, and oil inside a 30-day period, we've never had a move like that without jobs being down like 100 100,000 to 200,000 within 3 months.
So what's
yeah, go ahead.
So what's the breaking point here? I mean, you talked about emerging markets. You said multiply that by 10. And are we seeing that already beginning, or are we not yet even seeing it? And we're just sort of on the precipice, and we're seeing the beginnings of the breakage in the dollar, in what you're seeing with the Japanese yen, in what you're seeing in certain markets for risk assets?
The Fed is trying to stop inflation in the United States by promising, 1,000 rate hikes, essentially, right? I'm just exaggerating, but about 15 rate hikes, including $1 trillion of quantitative tightening. The rest of the world is not doing anything in that regard in the developed markets, except for maybe Canada. So what happens is when the dollar strengthens and you're in Indonesia or any emerging market country, you're trying to buy wheat, you're trying to buy corn, you're trying to buy oil, gas. The Fed is essentially exporting inflation from the United States to the developing world, and they're crushing civilizations around the planet.
Larry, I got to get this one question in before we go, and that is the famous shot of Lehman Brothers, and they're standing there watching the deterioration of the company, and the Gartman report is up on the guy's screen as well. That was a time of leverage. The optimists are pushing back against you, saying the leverage here is not like it was in '98 or in the great financial crisis. Do you buy it, or is the leverage just different in different place this time?
Well, behind me, we run a Bloomberg chat, Tom, with institutional investors on the buy side in 20 plus countries. So we monitor the conversation. In the last 2 weeks, 3 weeks, the conversation from buy side investors that run billions of dollars is focused on sovereign risk, and that's where your nose has been focused on this week. And so exactly, we've transferred the Lehman risk from the balance sheets of the banks to the sovereigns, and now the Fed's accelerating rates up, and they're blowing up the global bond market, and that's what's going to stop them.
Larry McDonald, thank you so much. One of the essays of the summer, writing in Zero Hedge today, I thought it was fascinating. Lisa, I got goosebumps, literally, Lisa, over not the similarities, but just some of the allusions here to what we've seen in other crises. I go back to, I think it's Ecuador in 1992, if my memory serves me right.
We aren't seeing yet the fissure, though, in the credit space. We are not seeing companies completely unable to raise money. I'm talking about companies in particular.
Yes.
There are pockets of distress, but it's not the wholesale market shutdown, the market dysfunction that Michael Shaul is worried about happening. Doesn't mean it's not going to happen. But the fact that, and I think that this is a really important point that Larry raised, the fact that the Fed is so worried about something coming down the pike, that they want that fortress of cash, JP Morgan, to start holding more cash and be really conservative with buying back shares, tells you something very loud and very clear.
That is the fundamental difference, Lisa, this time around, is the amount of cash held, whether directly by banks, indirectly central banks, or just by the public. It's a radically different tone than what you've seen the 3, 4, 5 times before. Futures at -50, Dow futures were -500, they're -469 now. The VIX 27.84. A little bit, I'm struggling here, folks. A little bit of improvement in the last hours about what I can do on it. Dollar yen 139.15. That is a wow. Absolutely fascinating. On radio and television, this is Bloomberg.